Hey there, hello. Welcome back to my discussion on plant assets. My goal is to discuss the accounting for natural resources and intangible assets in this pencast, and I want to start, interestingly enough, with an overview of the topic. I think it's good to begin our discussion with an overview of what we know about property, plant, and equipment, or plant assets. We've talked about the acquisition of those and how to record the usage of them when we talked about journal entries to set them up and to depreciate them. I'd like to look at those in comparison with natural resource accounting, and then compare that also with intangible assets. I like to start with an overview because, as you'll soon see, a lot of things are in common. First of all, let's start with plant assets. Remember, these are things that are used in operations, like property, plant, and equipment, building, and machinery, and we depreciate them to show them being used up. And when we depreciate them, we make an entry that says depreciation expense and accumulated depreciation. And this entry shows that they're wearing out over time or through use. We looked at the accounting for them. We came up with acquisition costs. We also looked at how you calculated depreciation, and in that you needed cost and you needed salvage value, how much it would be worth at the end, and you needed to know its useful life to you. How long were you planning on using this asset? We learned 3 ways to write it off once you knew these facts. To depreciate it, we learned the straight line method. We learned units of production, abbreviating a little bit here, and we learned double declining balance as a method, a really fast method. And these were shown on the balance sheet when it was all said and done under long-term assets, and we listed our equipment or whatever it happened to be, and then we listed its accumulated depreciation, subtracted that off, and we showed it at its book value. So we had equipment at its cost. We subtracted from it accumulated depreciation. That's how much we'd written off through depreciation so far, and the difference being shown on the books was book value, or how much we have left to write off. No matter how you look at it, although acquisition costs is a good number, salvage value and useful life is an estimate. So depreciation is an estimate, and therefore the book value is also an estimate. Let's compare that then to natural resources. Natural resources are things that come from the earth and that we consume through operations. An example I'm going to use is an oil reserve. So we consume it through operations, and we don't depreciate it, we deplete it. And the entry that we're going to use to do that is similar to this entry. We're going to say depletion expense, and the contra account we'll use is called accumulated depletion. I better put an L on it so you can tell it's different from accumulated depreciation. So we don't depreciate it, we deplete it, but we make a similar entry. Everything we learned about acquisition costs that relate to planned assets relates to natural resources. All costs ready to get it in place for its intended use are capitalized into the resource account. We take an estimate what its salvage value will be, if any, and we also need to know, in this case, how many total units or total gallons or total whatever will be produced through consuming the asset. We learn one way to deplete it. Of the methods you've learned to depreciate, which one makes sense for something that you consume? And hopefully, units of production come straight to mind, and we'll write it off as we consume the asset. And again, although we know the cost, the salvage value, and the total units we'll be able to produce are an estimate, so depletion is in and of itself an estimate. It's also shown on the balance sheet. And you would show, we said oil reserves for our example, you would show you have a natural resource called oil reserve and list its amount. You would say less accumulated depletion, that's how much you have depleted to date. And it would also be shown at book value, another way of saying that's carrying value for both of them. Sometimes you'll hear that term used. Been accounting long enough to know there's more than one way to do things now. So natural resources are very much like plant assets. The biggest difference is we don't use them, we consume them, and we use units of production to deplete them. Let's move on to intangible assets. Intangible assets have no physical existence, so they don't exist at all, but they do have value to us. Things like patents, copyrights, and trademarks. And we don't depreciate them or deplete them, we amortize them. Amortization expense. And the entry to write them off is not depreciation expense or depletion expense, but it's like that. It's amortization expense. And here's something interesting. Although you could go to an accumulated amortization account, generally we don't. Let's work with the patent. In this example, you would take the credit directly to the patent account. Now, we've been very particular about not doing that with plant assets, a matter of internal control and disclosure. They exist, so we put it in accumulated depreciation. And natural resources exist, so we put it in accumulated depletion. Accumulated depletion. But amortization or intangible assets don't exist. So we go directly to the account and write them off and show them on the balance sheet at their book value by showing just patents. Now everything we've talked about in acquisition costs applies. And they may or may not have a salvage value to us at the end of their useful life. And we also need to estimate what their useful life will be to us. We have one way of amortizing them off, and unless you can show a reason to use something else, generally accepted accounting principles suggest you use straight line amortization. Straight line amortization just writes it off evenly, and since they're pretty intangible, they feel like there's not a better way to do it. They're also shown on the balance sheet, and again long-term, like both plant assets and natural resources, but they're shown at net because you've been taking the depreciation right to the asset account. So there is no book value, they're shown at it. And you disclose the amount that you've written off for the period and to date in the notes to the financial statement. So that's our overview of where we're going to go with the topic of natural resources and intangible assets, I started by comparing the three categories. Let's let this pencast be short, and we'll do a separate one for natural resources and then a third one for intangible assets. Now that you have an idea of where we're going, thanks for